Okay, so talking more about clean technology. Now we're talking about clean technology innovation tax credits. And it gives me great pleasure to welcome Mackenzie Crabb to come up and moderate a panel that's going to be discussing this very topic.
Welcome to our panel discussion on the path to sustainable mining, clean economy and innovation tax credits. So thank you all for joining us. Today we'll be exploring a series of investment tax credits introduced by the federal government in June of 2024, aimed at promoting clean technology adoption and manufacturing in Canada. These credits represent a significant shift in how we incentivize sustainable practices for businesses in Canada, and they're designed to make environmentally friendly technologies more financially accessible for businesses, while also supporting Canada's broader environmental and economic goals. So today, our panel is going to be exploring the details of these credits, their potential impact, and how businesses can leverage them effectively. We're fortunate to have three experts who work in the field, so we'll be introducing them soon. Bryan Watson, we have Martha Breithaupt, and we have Martin McLaughlin. So I'll ask them now to introduce themselves. Bryan, why don't you take over?
Sure, I can go first. So Bryan Watson, been a pleasure to spend a couple of days with you folks, some of which I knew, some of which I didn't. Long in the tooth in the angel venture capital ecosystem, used to run the National Angel Capital Organization, spent a decade in the shred and incentives world, as it's known now, I guess. But relevant for this conversation, I've also been running Clean Tech North since 2012, helped start it in 2008. When clean tech was a very different beast than it is now, and have been advocating for these tax credits for well over a decade. We started the Ontario Clean Tech Industry Association in 2017 when there was a change in government, and have been very active working with the Ontario government to try and get them to understand the role that clean technology plays in industrial efficiency. And these days, mostly finance tax credits, mostly shred through Venbridge, but go figure, a $93 billion tax credit suite of tax credits is kind of interesting, and I'd love to be helping companies free up that cash flow, not when CRA gets the money back to them, so they can plant panels and good clean technologies on an ongoing basis, not just when CRA gets the cash back to them. So that's me.
Great. Hi, everybody. My name is Martha Breithaupt, and as I was just up here, I was like, it's very bright up here. But that is how you pronounce my last name. I know. But it's great to be here, and so it's great to be with esteemed colleagues that I have here. So Bryan, in the ecosystem for years and years. Myself, I've been around for 25 years, always on the non-dilutive tax credit and grant funding side, always working for clients to get money back for them, primarily for innovation, training, hiring, and export kind of things. So lots of fun that we're going to have today, kind of going through some use cases for these tax credits, how you can access them, the filing process, what to expect, and we would love to keep it conversational. So if you have any questions at any time as we're going through some of this stuff, please just do feel free to reach out, and we'll have Q&A at the end too. But fun fact, so both Martin and myself graduated from the exact same program. So we are both science and business graduates from U of W and have known each other for yeah, so a very long time. So it's great to be here today. So thank you, guys.
Thank you. My name is Martin McLaughlin. I'm a partner at EY in our incentives practice. I actually lead our capital asset review practice and these investment tax credits. So we look at everything from large capital projects, looking at tax deductions, depreciation, which most of these tax credits fit into. As Martha said, she stole my thunder. Fun fact is I've known Martha for this long, and as you know, I've been in the space for 20 years. There's a reason why we went to university together. There's a reason why I kind of have a small retirement phase there where I left and moved to Europe. But anyways, all that aside, I've been in the space for over 20 years now, and I've had the opportunity to work with both Martha and Bryan. So.
Thank you very much. So what we're going to do now is we're going to do a little education piece. So we're going to spend about 5 minutes kind of introducing you to these tax credits and what they mean. All right, so what we're going to do is we're going to start with Martin. Can you start us off by explaining what these tax credits are?
Absolutely. So when it comes to these investment tax credits, Canada has some very ambitious goals of meeting net zero by 2050. In order to accomplish this, they've really laid out sort of a series of strategic priorities that date as far back as sort of 2021. Within those priorities, they look at things like decarbonization, critical minerals, which I know is very pertinent to this audience, looking at clean technologies, looking at electrification. All of this actually from a mining perspective really fits in really well because most of these industries have a role in when we're looking at all of these strategic priorities for the Canadian government. Along with that, they introduced things like strategic finance, so the Canada Infrastructure Bank and the Canada Growth Fund. They laid out some targeted programs, grants, or low interest loans. And in addition to that, they've got this series of investment tax credits, and there are actually 6 of them. The 6th is the most recent one, and they cover everything from the extraction of minerals that are critical for the manufacturing of clean technologies. They cover the equipment used to manufacture those clean technologies, carbon capture projects. I know that was talked about in the last segment. They cover clean hydrogen. They cover really everything, even bringing clean electricity across provincial borders. Lastly, there's this adoption tax credit, which is really available to any types of businesses. You can think of real estate, anyone who's investing into solar panels, backup energy storage systems. And in the mining industry, they cover things like non-road zero-emission vehicles. So you can think of this as, earth-moving equipment or equipment that would be used for the construction industry. All this to say, the credits are all refundable. They range anywhere between 15 and 60%. That really depends on a number of different factors, including things like labor conditions that are related to some of the investment tax credits. But the nice thing about the refundability of these credits is that they really closely if you're a non-taxable business, we get this question a lot. From a non-taxable business perspective, think of this as cash back right away on your investment. Now, we'll talk a little bit about some of the nuances as we go through this because they are very nuanced, these programs. But all this to say that they really cover everything from coast to coast from any type of technology that would push us towards a clean environment.
Now, Martha, can you explain to the audience the intent behind these tax credits?
Yes. So I would say generally it's really twofold. So firstly, we all know we've got to meet our 2050 Paris Climate Target Agreement, and that's not going away. So we've signed on to it. 194 other countries have signed on to it. And really the time is now for us to make an impact and actually meet those targets and goals. And so as part of this program, you'll notice that all of these tax credits are around really for the next decade. And the reason being is the government feels that this is really our time to act is the next decade in order to make that substantive change. And then the other competing fact, and the reason why we have these great refundable credits, is the IRA. So we started seeing some lack of foreign investment attraction into Canada, losing out some really big solar, clean hydrogen projects to the US. And so we brought these credits in really to offset what the IRA brought in, so trying to match the playing field. So a couple of reasons there.
Awesome, thank you. And Bryan, can you finish off this piece by kind of explaining who could benefit from these tax credits and why should we care?
Yeah, absolutely. So, Hatch did my job for me. So did Trin. But honestly, every time you saw clean in one of those slides, the alarm bells should be going off. Every time you're thinking about remote mining, you're thinking about batteries, just remote electricity generation, warning bells should be going off. Talk to myself, anybody on this panel, to look at those assets and see, should we be looking at these tax credits? Because the answer is quite possibly yes. So who should be looking at these? Anybody that is, if you're building a CCUS plant, you should probably look at the CCUS tax credit. Hydrogen, same sort of thing. If you're in storage technologies, those are fairly direct line of sight. Clean tech, though, is an implementation tax credit. This is, a company that buys a battery and puts a bunch of panels to offset electricity usage for some industrial process, or you're building a small precision mining operation with Nova Mera, and you need a little bit of power and wind and solar and battery backup. Any of those applications is a corporation buying clean technology properties, technical definition in the legislation. Anybody that's buying those properties is eligible for those tax credits within the legislation. So it could be a building retrofit, it could be a industrial company, it could be a mining operation, it could be buying a $10 million 3-story rock truck that's hydrogen electric, and I'm seeing schematics for those on some of the slides too. So all of that whole suite, clean aviation, that whole suite, it could be any users or adopters of those. The other side is the manufacturing tax credit. So that is honestly poorly named because it's not just manufacturing, and particularly for this sector, think of it as manufacturing the materials. So really, mining and processing is what it should be called. And I think in the original announcement, it was actually manufacturing and refinement was the original name, I think. But this is the capital cost of the refining technologies and the processing technologies to create critical minerals and a number of other clean technology properties. So things like Destiny Copper, their system for extracting copper, that could potentially be fully covered. The capital cost of their equipment for a mining operation to refine that copper, possibly fully covered, and the capital to create that. So it could be that's probably the one that is most directly relevant to a lot of the startup companies, because it might be the capital cost to manufacture their equipment to then be bought by an adopter. So lots of folks can take advantage.
Awesome. Thank you all for that. So now that we have a good foundation, we're going to get into some practical questions. So Martin, I'm going to go back to you now. Can you walk us through the application process, and how can companies file for these tax credits? And what advice would you give to companies who are looking to apply?
There's a lot in that question, so I'll take them sort of one at a time. And Bryan touched on it really nicely when he talked about, what the intent is in some way around the manufacturing ITC, and we'll talk about that in a second because it really touches on the second point or the second part of the question. But I'll start with what you need to do to file. So one of the things about most of these tax credits, now the carbon capture one is sort of the outlier in this, but they generally rely on the available for use date of the asset. So what you'll end up doing is once your property is available for use, and I know there's a question later on where we're going to talk through some of these rules, but just know that you buy a piece of property. Let's use our mining trucks as an example. Let's use some earth moving equipment. You buy it, arrives on site, it's ready to go. You don't have to do anything to plug it in, get it ready. Once that asset is available for use, you'll claim it on your income tax return in the year in which that asset is available for use. So generally speaking, you purchase an asset. And to step back, most of these tax credits, all of them actually, rely heavily on capital cost allowance classes. So what that really means is, for those people who aren't tax folks in the room, is that's where your schedule for depreciation is for tax depreciation purposes. So the government's aligned these tax credits with specific capital cost allowance classes. There are supposed to be prescribed forms that are going to be coming out at some point in time. That date shifts, but at the moment there is a way to file for them. So let's say you bought a non-road zero emission vehicle for your mining operations. You install it, you install the charging equipment, that's all available for use. You can claim it on your tax return now on a schedule which houses all the tax returns. It's called the Schedule 31. And effectively, there's a single line on there, I believe it's 570, and you would add on sort of the capital cost of your property, and the investment tax credit would flow through there. Along with that, they want you to keep a lot of documentation. I think it feeds in nicely to the second part of the question. They want you to provide, an overview of the equipment, what capital cost allowance it fits into, when the property was acquired, and a number of other things that they say that you should be submitting with your return at this point in time, which kind of gives you an indication of what these forms are going to look like when it does end up coming out. Which leads me to the second part of the question, which is, what do people need to really think about with these investment tax credits? And I think there's a perception out there, this is not meant to scare folks, I'm just being realistic. I think there's a perception out there that, I've bought a piece of equipment and it fits into a certain capital cost allowance class, and I just drop it on the Schedule 8 and I drop it into the prescribed forms and it calculates the 30% credit and away we go. The reality is these credits are large, very large. 30% of $100 million, $30 million is a lot of, and a lot of projects are going to be, can be that size, but even $1 million, $300,000, the government is going to come and look at some of this stuff. All of the stuff. As a taxpayer, you know what? Great. So the other part around it is that some of the tax credits, in fact, 4 of them have, and there's nice little asterisks beside it. Oh, no, there's not. Usually there is. But anyway, some of them have labor conditions that are attached to them. And effectively what these labor conditions say is that using our example of backup energy storage system at a mine site, for example, you're going to have electricians, journey people, tradespeople who are going to be there putting in that property. Those folks are subject to prevailing wage conditions and some apprenticeship conditions. So you have to attest and sort of file for these things along with all that information. What that really means is that you need to be prepared, because the legislation is such that if you miss out on the labor conditions, your credit is reduced by 10%. Now, not 10% of the 30% or 3%, it's 10%, which is really 33% of the credit. And if you're going for the clean electricity credit, which I'll talk about in a second briefly, that represents a 15% drop to a 5% drop, so 67% of your tax credit. So it can really have an impact if you're not paying attention to some of these labor conditions. The second piece around this is that they all have sort of different groups of people who are eligible for the credit itself, and most of them rely on taxable Canadian corporations or corporations that are members of partnerships. But some of them allow for non-taxable entities like corporations owned by Indigenous communities or municipalities. So partnership structure really matters. I know a lot of these projects end up having partnerships in play, and you end up with partnerships with multiple different entities and groups that are part of it. Thinking through the structure of the business and the project that you're undertaking is going to be of the utmost importance, because it can really impact what credit you get, whether you get a credit, who picks up what credit. And the other side is that there are, for those familiar with some of the limitations around limited partners and restrictions, there's also that. So without getting too technical, there's a lot of things to think about. Documentation is going to be key as you sort of undertake these types of projects. And that's really just means planning.
Great, thank you. So now that we have a good understanding of our application process, maybe we've touched on it already a few times, that refundable piece. Bryan, do you think you could kind of explain the significance of the tax credit being refundable?
Yeah, absolutely. So actually, hands up, have folks in the audience ever been through a SR&ED audit or filed SR&ED? Yeah. How many have actually been through an audit? I'm sorry. You should have used these guys. But
we enjoy it.
Yeah, seriously, they're a little nuts. But no. So if you've been through that process, if you filed SR&ED, probably for a lot of the companies in this room, most of what you got back was a refundable tax credit. You got cash back, a couple of weeks after you filed your tax. Well, a couple of months after you filed your taxes these days. You got a big transfer, hopefully electronic transfer into your bank account. You go look at it, and go, what's this thing? Oh, my SR&ED came in. Great. For a lot of companies, especially public companies, larger companies, that becomes a non-refundable tax credit because it counts against your taxes owing. And so that's really the difference. Refundable, cash back; non-refundable, it'll count against your taxes and lower your taxes. In this case, all these tax credits are cash back. This is helping near-term cash flow. And why that's important is, I've got a lot of companies that are on, junior stock exchange and things like that. They've gone public. And so they lost that CCP status, Canadian Controlled Private Company status. And so all of a sudden, all their tax credits became non-refundable, which will eventually be useful for them, possibly in 20 years. Possibly sooner, but it doesn't help with the near-term cash flow management problems that they might have. So, unlike SR&ED, most of this is refundable, and because of that, it pumps money back into the system so that you can then go and buy more rock trucks that are electric or hydrogen-based, or plant more panels or plant more batteries to have a remote location. So this is really, really important, and we were really pleased to see that this was part of the legislation, and that it was mostly going to be refundable.
Yeah, that's really interesting. I mean, we've talked about training today and retaining your workforce, and I mean that might have some benefits there for sure. So, Martha, we're going to move to you. So we've touched on SHRED now. Everyone in the room is pretty familiar with it. So can we talk about how stacking works? So how do these tax credits stack with other tax credits?
Sure, and I think our previous presenter was also talking about stacking. So when we are preparing a claim, we essentially take that pool of all of your expenditures, so everything that you've put into that project that is going to be capitalized, as Martin said, on that Schedule 8. And in order to claim the credits, we have to reduce by any funding that you've actually received, because at the end of the day, you cannot double dip. So we will take a look to see what funding did you receive. Was it CRIN? Was it SIF? Was it MICA? Whatever it is, we would offset that funding and then claim the remaining expenditures. The other good thing with stacking, so not only can we stack grants in that sense, we can also stack credits. So in addition to all of these credits that you see here, there's a little asterisk there because in Atlantic Canada, if you operate in Atlantic Canada, you can actually add another 10% right on top of all of these credits. So not only, again, can we stack with grants, but also with these tax credits. So at the end of the day, the goal of the government is really to move the needle on those Paris Climate Agreement targets and to really green our economy, our manufacturing and mining industries.
Thank you very much. So Bryan, do you think you could chat to us a little bit more about the Clean Technology of Manufacturing ITC and how that might benefit technology developers and SMEs?
Yeah, absolutely. I somewhat jumped the question before, but really for companies that are developing the technology, the manufacturing tax credit, I think, is probably the most relevant in that it may help them build out. There's a great company, eZinc, zinc battery technology company, just opened their manufacturing facility in Mississauga. So I can't speak for their actual expenses, but most of the expenses, I would think, in that facility will be potentially covered by the manufacturing tax credit, because it's scaling up the manufacturing capacity of that scale-up company to produce clean technology properties. So that's one way. The other side, though, is pull-through. So if your widget qualifies for a clean technology tax credit, so the 30% tax credit, there's a pull-through that you're going to get to your customers because they get the tax credit. So you're selling we'll pick on eZinc again. You're selling a battery to a long-duration energy storage company. That company, your customer, gets that tax credit, that 30% tax credit. So there's a demand creation that's happening there with that tax credit. So not only are you getting a tax credit based on the scale-up and manufacturing equipment cost that you're generating, you're also potentially getting, your customers are also potentially getting, if the technology is a clean technology property, and there's a whole list of technologies that are in there, some weird ones that you'd think would be in there that aren't, and some that are, that you're kind of like, okay, that's in there, that's interesting. But there is a whole litany of technologies. If it's on that list, then your customers can get that. And so for companies, what I'm starting to recommend is they build into their sales documentation a way to educate their customers about how this all works. Because if you're talking about you're retrofitting a old age home to be a little more green and putting heat pumps in there, quite possibly that company that owns that retirement home doesn't really know that much about clean technology tax credits. But you want them to know that so they file properly and get that tax credit and can do more retrofits or what have you. So there's really two vectors in there.
Interesting. What about companies that might not be covered under the tax credits? Are there any options for them to kind of benefit from this?
So if they're not covered under the tax credits, unless it's a clean technology property in that list, the answer is no. And so some notable exceptions of things that I think should be in the list, for example, would be some of the green chemistry companies that are out there, some of the disintermediation of different types of harmful chemicals with non-environmentally impactful chemicals. So there's lots of different things that I think should be in there that aren't, but that's a conversation to have with one of the two entities. So CRA processes the applications. Natural Resources Canada is the technological imprimatur, stamp of approval for the technologies that are kind of in or out, and with a bit of a feedback loop with finance to make sure that it's all within budget. But there's a widening of that aperture of technologies that could potentially happen, and we've seen with biomass and a couple of other technologies that they've added in along the way. But it is another note to say both entities have a role to play in this, Natural Resources Canada and CRA, and there's guidance from both that in some cases you have to seek. One shout out for NRCan is I'd love to see them get a little bit more resources because there's all of 2 people that we know of in Canada to process all of these claims, and that may become a very interesting bottleneck very quickly. So we're hoping that there's a little bit more resources to come there, because if there's any question of, is my technology really a clean technology property under schedule 43.1, 43.2 in the capital cost code, you have to go to them to get that answer. So I don't think the pipe's too full yet for them, but I suspect it's going to be very soon.
So you kind of touched on a bit of a bottleneck there that might come into place, one of the challenges that companies might face when they're filing for these tax credits. Yeah. Are there any other bottlenecks that you think the audience should be aware of?
I mean, process bottleneck in terms of the forms and or not having them, I think is certainly a bottleneck. I think there will be a bit of a bottleneck in terms of the audit side, but I might let some of the other panelists talk about that side, because it is the SHRED Directorate that is processing these at CRA. So it's the SHRED people that are processing the clean technology tax credits, which, you're repurposing people. They didn't hire new people. So it's going to be interesting.
I would say probably documentation. I think, Martin, you touched upon this earlier. And so one of the requirements that you heard was that in order to get the 30% and not be down at 20% for that clean technology tax credit, is you have to show that the labor that you used on the job site, so if you think about a large solar installation, for example, that the labor that you used met their qualifications. And what is the qualification? That you're meeting the prevailing wage rates across the country according to the Canadian Building Trades Union Association. So they're all published. It's very easy to determine if you are paying them or not. What isn't easy is to document that you have paid them all of that correctly throughout the entire course of the job. And so what you have to do when you do go to file is you have to both elect to claim that additional 10% as well as attest that you have paid those people, that you have communicated to those people that they were paid at those rates, that they are have a whistleblower line. You have to have posters and communication up on your job site so that they know that they can go to CRA and say, hey, I'm not getting paid enough, and then that 10% is gone. This program has the most egregious penalties I have ever seen. I don't know if you have seen. So in addition to kind of the standard things that you would see from the SHRED program, like standard penalties or interest, things like that. There's gross negligence penalties, and then there's additional penalties in regards to the labor, where if you haven't paid those people, you can be on the hook for $20 to $50 a day per person on your job site, and you have to make sure that you go back and pay those people at those amounts in order to get the credit. So it's a lot of documentation, and I would say that that's going to be some of the bottlenecks that we might start seeing with some of these projects. Now, the good thing, and I don't think we've mentioned this, but I think it was on the slide, is that we can go back in time and pick things up. So we do have from March 28th of 2023, which was essentially the date of the budget, which is when these were announced, and then it wasn't ratified until June of this year, and now allowing us to claim. But because they announced it in the budget, that means that businesses start to take that seriously. Businesses start to make investments based on what they read and see in the budget. And so we can go back in time. Now, the thing that they did is after the budget, they kind of thought about, well, wait a minute, we want, and again, it gets back to the intent of this program, we want to create good, safe Canadian jobs. And so that is really the goal here, because it does require these red sealed trades as well to be included. So we're bringing in training up. So you're starting to see a lot of these themes across many of the projects, meaning the grant programs as well. They do tie in this manner. But I would say that's going to be a big area that's going to trip a lot of companies up, is that documentation. I don't know if you have
I mean, I think the documentation is bang on. I think another part of it is, Bryan touched on it already, when he talked about the fact that there's NRCan and there's CRA, but as Martha was saying, the builders' trade unions as well kind of play a role in this whole situation. This stuff is new. Like you touched on it earlier when you said that this is kind of like the IRA mini. I say it's the IRA mini in some senses, and I think we're punching above our weight, to be perfectly honest. It's a lot of money for Canada. What I would say, though, is that there's a lot of people who have a vested interest in making these things go forward and making them, this is a very successful program. And the labor conditions, as an example, as Martha was just talking about, those were stolen directly from the Inflation Reduction Act in the United States. Like the idea came from there. It's very obvious, but we've never implemented, at least I haven't seen this in Canada, like implemented anything of this sort where you have those labor conditions attached to an investment tax credit. So, the builders' trade unions are trying to teach CRA and people how to and everyone, we're all trying to kind of see this stuff kind of through. And so CRA is going to have to administer this entire system with the backing of NRCan and with the backing of builders' trade unions. All this to say is that it's going to be, I would say that they're doing their best to get this stuff through as quickly as possible, but it's going to take time, I think, for it to kind of hit that sort of stride and smooth operation. But I mean, from everything I've seen, they're taking the right steps to do this. So hopefully that there will be minimal bottlenecks, but I think there will be.
And one thing I just forgot to mention, so the program, we can go back to March 28th, but these covered worker requirements weren't brought in until November. And so if you have a project, and we touched upon this earlier, so let's say you spent money and you purchased something in 2022. So you bought it, and then you put it in place, so you installed your solar and it became available for use, and let's say it was June 2023. So those timelines matter because what that means is that we can go back and claim everything at 30%. You don't have to show that you met any requirements, but if it was November 29th that your solar was literally flipped on and became available for use, you would have to show everything, otherwise you're claiming it at 20%. So it's a big time change as well there. But.
And so it's interesting because these have been co-evolving at the same time, and so that could lull people into a false sense of security of they won't be particularly audit heavy or what have you. And my recommendation would be save all your homework, especially if you've been through a shred audit. Save all your homework, have everything documented. I have heard even folks at CRA use the words MVP. But not the MVP, minimum viable policy, which I don't know if it scares the bejesus out of me or makes me really excited. But they have been iterating on the policy as we go, which has been amazing.
The consultation.
12th.
Yeah, the consultations are like this is good, but you don't let that lull you into a false sense of security that they're just going to let things slide, because I think that is a trap that could very, very well bite people in the you-know-whats.
One thing I'll add, think about the type of investment tax credit you're going for, because we talked about the clean technology ITC, which has the labor conditions attached to it. But if I buy a piece of mining equipment and I'm extracting lithium, cobalt, nickel, copper, graphite, rare earth, critical minerals that are covered under the clean technology manufacturing ITC, there's no labor conditions. So if that same piece of equipment is being used to extract those pieces, now there is an exclusion for the zero emission vehicles, but let's say I'm using some, like a processing plant or something like that. There is a way, it depends on the incentive program, but the clean tech manufacturing ITC that Bryan talked about, that's the only one that really doesn't have labor conditions attached to it.
And I'm just going to say one more thing. You can tell we're all so excited about what's happening. So we've all been in shred for so long. This is something new and shiny, and it's, again, almost $100 billion. So it's a massive amount of money. But essentially, the zero emission non-road vehicles, those have no labor requirement because they are available for use when you get it. There's no labor that you have to administer it to, there's no electrical, there's nothing you have to do. So they're all available at 20%, again, fully refundable. So think of it as a fire sale on clean technologies. If your business wants to put in a solar carport on your parking lot, you would get 20 to 30% off the cost of that. I've got a client out west, they're a dealership. Again, this is wide open, there's no industry restrictions. They've put 2 solar carports across their dealerships. They did that last year during that time frame, had no clue about these credits. They spent $2.2 million, and they're going to get that back at 20 or 30%, right? So it's just a phenomenal, phenomenal program, and I would love for everyone in this room to go tell a friend, right? Whether they're in this industry of mining and energy innovation or not, just go tell them, because as we heard before, I have a long-term care home client that has 11 facilities, and they're putting heat pumps within them. I have, like there's residential condo owners, again, with heat pumps, and they're putting like 50, 60 of them in. So there's just so much opportunity for our country right now to move the needle on sustainability and leverage these credits in order to do that. So. I think we're stealing all your questions.
Yeah, no, I did want to touch on that. We're about to be kicked off the stage.
Oh, dang.
But I do want to end on a positive note, and just maybe we could all kind of chat a little bit about how these tax credits might positively impact Canada. So you did touch on it, but maybe we could elaborate a little bit, and yeah.
Honestly, there's the environmental benefits, and I love those, believe me. For me, a lot of it right now is the industrial efficiency. Some of these technologies, some of the technologies in this room that we've seen presentation for, they really move the needle in terms of the efficiency of companies, what sort of resources we can extract, how fast we can extract, how easily, how little energy we can put into the extraction process. That's one of the biggest things that excites me about Canada and the Canadian opportunity, especially in the context of falling productivity, which we've been suffering for multiple decades for. So this is a chance for Canada to really step up and Canadian companies to really reinvigorate that productivity and fill some of that productivity gap.
I guess my thought would be just around that productivity. So many of you mentioned the SHRED program. So about a decade ago, we got rid of capital. You used to be able to claim capital equipment as part of your innovation or your R&D tech project. That went away, and that aligned exactly with the 10-year productivity drop that we've had. So it's just been a disaster in my perspective, because what that message to all businesses across Canada was, no, we only want to invest in people, and we'll just do the labor and projects kind of on the side. No investment in capital means no investment in equipment, no investment in lab technology, things like that. And we've really suffered as a result. So all of these credits, you can think of them as bringing that back in a way. So it is all capital. And Martin mentioned that earlier. It's all based on the capital asset classes. So great to see, and I'm really glad that they've kind of recognized that. And I hope that it does turn that dial backwards on our productivity over the next decade.
I'll keep mine really, really quick. There's a lot of investment. You can see it in the news. It's coming into Canada. I think this is actually having a measurable impact on what's major projects coming to Canada. And I think that as global policy, global politics shift somewhat, it's possible that we could end up with more projects. So I think this is a great thing for Canada. Talked about productivity, both of you. And I just think of the impact that it could have long-term on sort of the education knowledge base that sits here in Canada and the number of amazing projects we get.
Awesome. Thank you all. Give the stage back to Shami.